Please note that the information on Retire Vivid is accurate as of May 30th, 2025. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. Information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm Karen McCarty. That's Tommy Breitbach. And so for our show, we talk a lot when it comes to financial planning, tax planning, wealth management. But today, we're going to go a little deeper down the rabbit hole and give our viewers some good examples of what we see with our own clients today.
Yeah, there's a quote out there. I may not get it exactly right, but plans are useless, but planning is indispensable.
Nice.
So it's just sitting down. It's evaluating all your options, putting all these pieces together. We're going to get into Social Security, taxes, withdrawal rates, all sorts of things, but putting all of those things together and just evaluating your options.
I would tell our viewers listening right now, buckle up, because we're going to be going through quite a bit. But Tommy, real quick here, we talk a lot about having that plan. And so it's that blueprint in terms of what we're looking at, meaning, when do we take Social Security, just like what you said? When can we afford to retire? We did an episode just on that alone.
You don't hope to retire, you plan to retire.
That's right.
And so it's, you've worked, hopefully you've saved, you have these assets there, how do we use them? What do we want them to do? How do they provide for what you want to do in retirement?
We're just going to be dialing in a little bit on some of the big ones that people look for, especially when they reach out to us. But Tommy, real quick here, before we even move an inch, we got to look at health insurance.
Yeah, health insurance, the big one being Medicare at 65,
right.
But that tends to stop people from retiring prior to that age.
Right.
If you're looking younger, there are options. You can, if your employer provides coverage to Medicare age, that's an option. You have the marketplace plans, you can pay privately. You have options, but Medicare being the big one at 65 kind of prevents people from retiring prior to that age.
Right. Even if you have the financial means to retire, that's usually what stops people. So that's a whole nother episode. We've already done that. So I encourage all of you to tune into that. Okay, so let's talk about Social Security. Let's talk about some planning that we do, but let's give our viewers an example. So let me set the stage real quick. Here we got John and Jane Smith. He's 62. She's 60, and he's going to receive $3,400 at his full retirement age, in this case, age 67, and Jane is going to get $2,500 at her full retirement age. We also added some other assumptions here. We're showing him living till age 88, her till age 92. I hope they live longer than that. And then we also have a 2% inflation. So let's dial into this real quick, because once we put in these numbers, our software will spit out this report and give us a number of things to look at. And the first one is a suggested strategy. Doesn't mean it's our suggested. And then the earliest strategy.
The difference between the suggested and the earliest, you have your full retirement age Social Security benefit. You go at age 62, you have a reduction in benefit that grows from 62 to your full retirement age. From full retirement age to age 70, you get those delayed retirement credits. So essentially from 62 to 70, your Social Security benefit grows.
Right.
And the software is going to evaluate, your assumptions, and then based on life expectancy being the big one, put out the different options. And so the first one being the suggested strategy based on life expectancy, they will both delay to age 70.
Right, that's a tough sell.
that becomes a very tough sell.
I want for our viewers listening, we're not telling you this is our suggested. We just want you to know, so keep going.
Yeah, so at age 70, they have John is going to make a little over $4,900 a month.
Yep.
Jane is right there about $3,700 a month. Mm-hmm. The expected lifetime benefits out there at $1,769,000 and change.
And change.
rounded around there, but just over 1.7 million on the lifetime benefits.
Okay. Now let's talk about the earliest. So if they file right away.
earliest benefit, they both take at age 62. Both when they are eligible at age 62, they both file. John will have close to $2,400 a month. Jane, right there, just under $1,800 a month.
$1,800. Yep.
Yep, and that the expected lifetime benefit is $1,417,183.
I mean, you look at that, that's a pretty big difference. I mean, that's over a $351,000 difference over their lifetime.
Right. If we could all shake our crystal ball and know what our life expectancy is, there is a right decision, but unfortunately we don't know that.
We don't know that.
It is you are there looking at about a $350,000 expected lifetime benefit.
It's a lot of money, but again, this is just showing the longest versus the earliest. But let's come up with some alternatives, and so we also have a first alternative here, Tommy, and this is where John. And now again, folks, I want you to know this. This doesn't mean that he works to this age. This is just saying he's going to delay to this age. Does that make sense? Meaning that in this case, John files at age 67. He's going to get roughly $3,753 a month. And then Jane files at age 65, and she's just over $2,300. In this case, they're looking at a $1.6 million lifetime benefit. So you can see here, we're getting closer to that age 70 number and just trying to be a little bit more realistic.
It is based on their life expectancies going out to 88 and 92. And so that the difference in lifetime benefits is over a long period of time.
Yeah, you know what? The next one, alternative 2, I really like this one. This seems a little bit more realistic. So in this case, again, folks, this is just assuming he files until this age, not that he's working to that age. It can be either or. John still waits until 67 because, again, we want to have that survivorship benefit. And then Jane files at age 62. Now, this lifetime benefit is at $1.5 million in change over their lifetime. But Tommy, the reason why I like this is what happens to the lower Social Security when we lose a spouse?
Right. It's you lose the lower benefit. The higher benefit continues on. The lower benefit goes away, and so it takes away some of the unknowns of maybe one spouse predeceasing the other by a number of years rather than a few.
I really do like this. I mean, this strategy alone, but that's the whole purpose, is just to give our viewers ideas of what they should be looking at when it comes to Social Security. So next, we're going to be dialing into how to supplement your retirement income when it comes to one of our largest assets. That's those IRA 401k plans. How does taxes play a role? Stay with us. More after the break.
Retirement planning can come with more questions than answers. How do I save money in taxes during retirement? When should I file for Social Security? And how do I retire my 401k? With so much to plan for, how do you know if you're making the right decisions? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to help get you retirement ready. Schedule your 15-minute retirement review today.
Okay, welcome back. So we just talked a little bit about Social Security, but I mean, everybody has different income needs when it comes to retirement. And Tommy, one of the biggest fears that we see out there is for our clients, and really anybody, is the fear of running out of money.
It's oftentimes from working and saving, moving into retirement, it's hard to kind of flip that switch. You've been saving, accumulating assets, and all of a sudden now you got to go into retirement. You may need an income supplement on top of Social Security or anything else you have. And so you got to look at spending those assets. So you just want to make sure you do it in a sustainable manner, your asset mix relative to how much income you need.
Right. And you know what? There's a lot of numbers that get thrown out there in terms of like, okay, what is a safe percent that I should be pulling from my IRA 401ks to accomplish that, where my money where my money outlives me, if you would.
There's studies out there, and everything changes based on how aggressively or less aggressively you invest, how long you live. But kind of a rule of thumb that we work off of is in that 4% withdrawal rate.
Right.
So your asset base, 4% withdrawal rate. For an example, $1 million turns into $40,000 a year.
$40,000 a year. So it's just good to talk to people, when it comes to what's a kind of a number to look at. But also, just like I said, I mean, people have different income needs, but it's not just the income, right? It's not just what you're making, but it's what you're keeping. I want to talk taxes. I want to talk taxes next. And so let's jump around. Let's have a little fun today. So let's jump to different couples needing different monies. I think it's good though. Let's make it simple for our viewers and keep Social Security the same across the board. Let's just say they chose this second alternative that we just talked about, before we went to break, of $68,000. Let's round it, $68,000 in Social Security. So Tommy, let's start with this first couple.
If they have, maybe after tax or Roth assets or whatever else they're using, but on their tax return, $68,000 of Social Security benefits by itself results in no federal or state taxes owed.
No tax?
Simple.
That's not a bad deal. It's the power of Social Security, right? Because Social Security is taxed differently than your traditional IRA, where that goes through ordinary income. Your Social Security goes through through a whole different formula before it gets spit out on the tax return. But the deal is this. Social Security, the way I look at it, it's kind of a stupid way of looking at it, but it's like a tube of toothpaste. The more pressure that gets pushed on it, IRA distributions, dividends, or capital, whatever, it starts to make it more taxable. In this case, there's no pressure, which causes Social Security not to be taxed. But in this couple, they don't have to file anything when it comes to taxes.
No, simple.
Very simple. Okay, let's say, okay, no, I want more. I want more. So in this couple, they're at $90,000 a year. Walk us through that one.
To get to that 90, you have 68,000 Social Security benefits. You add $22,000 of IRA distributions.
Okay.
That's showing out there. Little over $700 in federal income taxes, no state income taxes. So
right, but we had new tax law change that changed the standard deduction, especially for people that are 65 and older.
Right, they added a temporary provision for individuals 65 and older. There's an additional $6,000. In this example, a couple would get $12,000.
So now that means that $748, they're now looking at, look at this, zero tax on $90,000 of income.
Not a bad deal.
That just shows you the power of Social Security. And, we use it in terms of a tax planning opportunity. I love it.
Yeah, a combination of Social Security and tax planning.
Exactly right. So, and again, that $22,000 could be a pension too, because it's taxed the same as a traditional IRA. But okay, wait, there's more. Somebody says, okay, now here's another couple. They're saying, I need $120,000 a year. Walk us through that.
$68,000 in Social Security benefits. You got to add $52,000 in taxable distributions from the IRA to get you $120,000. Federal taxes owed on that are just over $7,000. No state taxes here in the state of Iowa.
$7,000 of Fed taxes, but now let's take a look at the new bill. They're now going to be just under $5,200 in Fed taxes.
Yeah, you're probably not going to get that same deal while you're working. So
no.
This is why we talk about planning,
right.
Where you're at, your asset mix, all those things, and then where you're going.
Wait, there's more. Okay, $150,000. Walk us through that one.
All right, 68 plus 82,000 out of that IRA gets you to $150,000. In this example, they're going to owe about $14,000 in federal taxes.
No state.
No state.
Yeah, it's still a good deal, but under the new tax bill, they're going to be just under $10,700.
We spend time talking about when taxes are on sale. With this temporary change, previously they would have been in the 22% bracket. They are now in the 12% taxable income bracket.
Wow. Again, Tommy, it's the power of Social Security. It's just that simple. So folks, when you're looking at this stuff and as you're listening to what we're saying, I think it's really important that you talk to your planners and say, hey, am I looking at the tax piece of this? And again, I think that's important. And Tommy, that's also why we offer this 15-minute retirement review. This gives our viewers the opportunities that maybe they're picking up something in terms of what we're saying, and they can ask us these questions. I think it's been extremely valuable to them.
Right, and we're in the next segment, we're going to get into required minimum distributions, and that's you have your traditional IRAs and pre-tax 401ks.
Right.
You have to take money out at a certain age, and so this is why we do emphasize the tax planning portion in addition to Social Security, wealth management, all those things. So if there are questions, if this is new to somebody, first time hearing about it, encouraged to reach out.
Encourage you to reach out. Let's just talk about this briefly too, about, do we take money proportionally when we're supplementing retirement income? Do we pull it from one source? Let's just, we've done an episode on this, but let's just briefly talk about that before we go to break.
Quickly, single individual, 62 years old, needs $60,000 after tax income, has $25,000 of Social Security benefit coming in, has $200,000 of taxable or non-qualified account, $250,000 in traditional IRA 401k, $50,000 Roth IRA or Roth 401k.
Right.
Those assets growing at 5% a year. And he's sitting there considering, do I withdraw my taxable, then traditional, then Roth in sequence, or do I proportionally take it and, look at my tax brackets, I guess, be smart about it.
Right.
And so across this example, by withdrawing sequentially, you can see in the middle there that no taxes, and then you see that bump in taxes when he takes the traditional IRA.
Yep.
Withdrawing proportionally, you can say there's a little bit of taxes each year. And so across this full example, in the sequential withdrawals, he's gonna owe about $57,000 in taxes. Withdrawing proportionally, owes about $35,000 in taxes. So he's saving right there off the top, saving about 40% of that tax burden.
That's awesome.
It's a real savings.
It is a real savings. Again, that's why we talk about it, right? It's not always what you're making, but it's what you're keeping, right? I hope this is hitting home for a lot of you. The tax end is so important when it comes to planning because, again, everything dials around that.
Right, and you mentioned at the start of this, the people's two largest assets tend to be their traditional IRA or 401k in the home.
That's right.
So we're looking at that IRA as a source of income in retirement, and next we're going to get into the required minimum distributions. Just planning ahead can make a lot of difference for people.
Well, and that's exactly where we're going. So I appreciate the segue. Okay, make sure you stay with us. We are going to hit on that. I also think it's important to talk a little bit about the Roth IRA as well when it comes to potentially Roth conversions. More right after the break. Okay, welcome back. So we're going to wrap up. We got some really good stuff we're going to share with you all today, especially when it comes to required minimum distributions. We did a whole episode just on that, and then we're going to touch on the Roth IRA. We did a whole nother episode on that as well when it comes to the rules of the Roth IRA. But Tommy, let's just first talk about the RMD. What is an RMD?
Your traditional IRA or pre-tax 401k, subject to you being retired, you have a required minimum distribution. That's where they've said you put money in, take a deduction, it's grown for as long as it's grown.
Yep.
At a certain age, you have to start taking that out. Currently, that age is 73. It is going out to 75 in the future. But when you reach those age, regardless of your income need or how much you're currently taking, you have to take a minimum percentage from that account.
Right.
Just general numbers, at age 73, that is about 3.77%. At age 75, it's just over 4%. By 80, it's getting close to 5%. So the percent you're required to take increases each year.
It goes up each year, hopefully your accounts are going up, which does what?
Makes your RMD bigger.
Bigger, which could then do what, right? Cause more taxes, right? It's a good problem. Don't take me wrong on that. Anytime you're paying more in taxes, that's a good problem to have. But with our clients, they don't mind paying taxes. They just don't want to pay any more than they have to, right?
Right, yeah. And when we're doing the tax planning or looking at future RMDs, all those things together, but you're looking at the tax brackets. You currently have the 10 and 12 are close together, 22, 24 are close together, yep. And then you go above that. And so if you have from our perspective, if you have the chance to stay within the 10, 12 and not go from 12 to 22 or the 24 to 32, those larger breaks,
yep.
We're looking at taking advantage of those opportunities.
Exactly, because clients are in different positions. And so let me give an example. I think this is going to bring our point home. So, all righty, folks. So here we go. We got a married couple. They have $275,000 in combined non-portfolio taxable income. They're taking a standard deduction. They also have $2.5 million combined between the two of them in tax-deferred accounts. And so these are the IRAs, the 401ks. And their annual growth is 6%. That's what we're assuming in this example. And we're looking at here the 2025 tax rate. So let's dial into this. So for people that have not done planning versus look at doing planning with these future required minimum distributions. So take a look at the first example. So here you can see the tiers. We got, as you mentioned, Tommy, the 10, 12, 22, 24, 30, so on and so forth. So with their income before they turn, RMD age, they are in the 24% tax bracket. But look at this. They weren't doing any planning whatsoever. And then boom, Tommy, the tax bomb just hit.
Right, and you can see they hit that break between 24 to 32. That's
a two-tier jump.
That's a two-tier jump, but it's a big difference there. It's an 8% up to 11% if they hit the 35.
Right. Absolutely.
It's a substantial difference in taxes.
So this is the stuff that we want people to get in front of. What is your future tax landscape moving forward, right? Because we were all taught this. While you're working, put into those 401k plans, get that tax deduction because you're in a higher tax tier when you're working, and then when you retire, you're supposed to be in a lower tax tier. That's not true for everybody.
Right. I mean, if you've been a good saver, it's very easy to go back or
right back up
or higher than you were.
Well, that's it. That's what this example shows. So what can we do? What can we do in terms of planning? So let's go back to this. So what we're doing now, you can see we got the same deal, but they're doing Roth conversions in this case. So all they're doing is they're filling up the bracket. I mean, we don't want to pop into the next tax bracket. We just want to know what is that number to fill up that tier. And you can see in this example, we filled up that tier, minimizing those RMDs in the future. Because here's the kicker. That required minimum distribution that you have to take cannot go into a Roth, meaning RMDs cannot be converted, period.
It's just looking at where you're at and where you're going to go. And those RMDs, they do not care if you need the money or not, you have to take it out. And so if you know you have to take it out sometime in the future, evaluate your options now.
Let's just briefly talk about the Roth. And again, folks, I encourage all of you to go to our YouTube channel and take a look at our 5-year rule. We explain all of this in great detail. I mean, we did a whole episode on this when it comes to the Roth, because I think, when we look at a conversion, a lot of people think, oh, there's a 5-year rule on every conversion. Well, hold on for a second. Maybe.
It's kind of true.
But it depends, right? Let's just talk about that for a second.
Right, so looking at, using your Roth IRA, there are 2 5-year rules. Your Roth IRA has a birth date. It's the first year you've done a conversion or made a contribution.
Yep.
Your Roth IRA needs to be open for 5 years to use the earnings on that contributed or converted amount tax-free. Then there is a conversion level 5-year rule, which applies under 59.5. So if you have your Roth IRA open for 5 years and you're doing conversions into it, the account level 5-year rule trumps the conversion level 5-year rule.
Right. So is that clear as mud? I mean, we did a whole episode on this. And so again, we encourage people to go to our YouTube channel on that. Tommy, and also I do encourage people again to take advantage of that 15-minute retirement review. I mean, we talk about a lot of things when it comes to your finances, your taxes, your wealth management, your portfolio. I mean, obviously we try to do a broad stroke across the board because we don't know who's listening to the show, right? But I think it's been very helpful for our viewers.
Getting into these shows, you have to move kind of quickly to get enough information out there. And so if something has sparked a question or you're considering your individual situation, a lot of times those can be answered pretty quickly.
They certainly can. So again, folks, I hope you learned something today. I mean, we tried to, go deeper down this rabbit hole with you just to kind of show you what's what when it comes to all these different planning opportunities that you have. But Again, thank you for watching. I mean, we are on every weekend helping you, guiding you, giving you the tools that you need so you can make an informed decision during your own retirement journey. And also, please DVR our show. I mean, we are on every weekend talking about a variety of different topics when it comes to retirement and finances. So again, we'll catch you next weekend right here on Retire Vivid.
Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a CC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives and is not intended to provide investment, tax, or legal advice. Viewers are encouraged to seek advice from a qualified attorney, insurance agent, tax or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.